You saw the headline, record revenue, record profit. Then you looked at the chart and it was red. That gap between results and reaction is where people lose money. The numbers were great, the expectations were greater. Everyone is grading Nvidia against a once-in-a-decade pace. 6% sequential growth at this size is still elite, but it was slower than last quarter. Data center grew, but the mix shifted. Compute ticked down. Networking carried more weight. That is enough to trigger doubt when a stock is priced for perfection. Here is the problem we need to solve today. Are we seeing deceleration or deterioration? Is demand peaking, or is this what normalization looks like after an insane run? If you want conviction, you need a framework that explains why a great print can trade down and still be a great business. Stay with me. Here is the hard truth. Elite growth can look weak when you compare it to a miracle. Nvidia just reported $46.7 billion in revenue, up 6% quarter over quarter and 56% year over year. By any real standard, that is domination. The stock dipped because expectations were set at fantasy levels, not because the business cracked. Look at the breakdown. Data center, $41.1 billion, up 5% quarter over quarter and 56% year over year. Gaming, $4.3 billion, up 14% quarter over quarter and 49% year over year. Operating income surged 31% quarter over quarter. Net income jumped 41% quarter over quarter. These are not weak numbers. They are elite numbers just coming off an extreme streak. Here is the reality. The bigger a company gets, the harder it is to keep posting double-digit growth every single quarter. A slowdown from 15% growth to 6% growth is normal at this scale. Deceleration does not mean deterioration. It means the base is massive and the engine is still running hot. Now look at what management guided. They expect $54 billion next quarter, plus or minus 2%. That implies another 15% quarter over quarter lift if they deliver. You do not guide like that if demand is falling off. You guide like that when orders are stacked and customers are still hungry. The takeaway is simple. Record revenue with slower growth is still record revenue. The curve bent. It did not break. Judge Nvidia by the real numbers, not by Wall Street whispers. When you break down the data center results, the real story is not the total, it is the mix. Nvidia's compute revenue slipped 1% quarter over quarter, while networking revenue surged 46% quarter over quarter and 98% year over year. That shift matters. Wall Street did not want networking to carry the load. They wanted another surge in GPU demand to prove the AI wave is still accelerating. Instead, networking stole the spotlight. For investors conditioned to see GPUs as the growth engine, this looked like a red flag. But here is the truth. Networking growth is not weakness. It is Nvidia selling full systems, not just chips. Every NVLink and InfiniBand sale locks customers deeper into the ecosystem. Once you build infrastructure on Nvidia's stack, switching out becomes almost impossible. This is what makes the moat wider every quarter. The problem is perception. Wall Street grades on expectations, not fundamentals. Compute softness looks like cooling demand, even if networking strength proves the opposite. And geopolitics amplify the noise. With no H-20 shipments to China this quarter, investors saw policy risk layered on top of a mix shift. The takeaway is simple. Networking strength expands the moat, but the market wanted GPU fireworks. Nvidia gave them system-level dominance instead, and the stock got punished for it. And this next part is important. The stock did not drop because the business was weak. It dropped because investors were grading against fantasy. Wall Street had whisper expectations well above the official forecasts. When those whispers are not met, the market punishes even a strong print. Think of it like this. Investors are not reacting to what Nvidia earned. They are reacting to the gap between what they dreamed and what reality delivered. 6% growth quarter over quarter at this scale is historic, but it looks soft compared to the wild double-digit streaks we saw in the past. In markets, perception often matters more than the truth. Another factor was narrative fuel. Operating cash flow fell compared to the prior quarter because Nvidia paid roughly $8 billion in taxes. That is not a structural issue, but for short-term investors, it was an easy headline to sell against. Add in the mix the shift away from GPUs carrying the quarter, and suddenly the bear case had sound bites to latch onto. This is how Wall Street works. The numbers say strength. The narrative says slowing. Investors trade the narrative, not the balance sheet. That is why you can have record profits, rising margins, and a stock that still closes red. The takeaway is clear. The stock fell because expectations were insane, not because the business failed. When the bar is set at impossible, even great results look average. That disconnect is where disciplined investors separate from tourists. Investors often confuse slowing growth with collapsing demand. They are not the same thing. Nvidia's revenue growth slowed to 6% quarter over quarter. That feels like a step down compared to the double-digit streaks we've seen, but context is everything. Think about football. 2 years ago, the Miami Dolphins beat the Denver Broncos 70-20 in one of the highest scoring games in NFL history. Now imagine the next week they beat the Kansas City Chiefs 35-10. Scoring 35 points is still elite. It's just 50% less than the week before. Does that mean the Dolphins' offense is finished? Of course not. It means you are comparing a once-in-a-lifetime outlier to another dominant performance. That's what investors are doing with Nvidia. They are looking at the 6% growth and calling it weak, when in reality it is just slowing off an extreme base. At $46.7 billion in revenue, the numbers are already massive. Growth at this scale will naturally slow down. That does not mean the engine is broken. The right way to frame it is this. Nvidia is still putting points on the board at a level competitors cannot touch. The pace cooled from insane to strong. That is not deterioration. That is what dominance looks like when you're already on top. The takeaway. Investors need to stop grading every quarter against outliers. Deceleration is normal. Deterioration is danger. Nvidia is showing the first, not the second. Now let's talk margins, cash, and the full stack moat. This is where Nvidia separates from the pack. Most chip companies scrape by on middling margins. Nvidia just put up 72% gross margin with an operating margin around 60%. That is software-like economics produced by hardware. Almost no one sustains those margins at $40 billion plus in quarterly revenue. That is not luck. It is pricing power and product gravity. When demand is relentless and supply is tight, the leader writes the terms. Nvidia is not selling parts, it is selling systems. CUDA, NVLink, Spectrum, and the Blackwell platform turn a chip into a solution. That creates outcomes customers pay up for, which is exactly why margin stays elevated even as volume explodes. Now look at the firepower. $56.8 billion in cash and marketable securities against about $8.5 billion in debt. The board just approved an additional $60 billion share repurchase authorization. Strong cash, minimal leverage, and repeatable cash flow give management the freedom to invest, acquire, or return capital without blinking. This is how the moat expands. The software stack drives switching costs. The network fabric ties clusters together. Rack-scale systems lock in workflows for years. Once a customer standardizes on this stack, ripping it out is expensive, risky, and slow. Competitors can chase specs. They cannot easily break that lock-in. The takeaway is simple. Nvidia is delivering software like margins from a semiconductor platform while building the default infrastructure for AI. With this level of profitability, liquidity, and ecosystem control, the gap with rivals is not closing, it's widening. Now, every investment has a catch, and Nvidia is no exception. The upside is massive, but the risks are real. If you ignore them, you are gambling, not investing. The first risk is customer concentration. Half of Nvidia's data center revenue comes from a handful of hyperscalers: Amazon, Microsoft, Google, and Meta. If even one of them slows spending or shifts more workloads to in-house chips, Nvidia's growth curve can flatten fast. When your top customers are also your biggest competitors, that is a structural risk. The second risk is geopolitics. This quarter, there were no H-20 shipments to China because of export controls. That is billions of dollars in demand locked out by policy, not by performance. Washington can change rules overnight. Beijing can retaliate. If you are betting on Nvidia, you are indirectly betting on stability in the U.S.-China tech relations, and that is a coin flip. Third, expenses are climbing fast. Operating expenses grew nearly 40% year over year. Stock-based compensation and R&D are swelling as Nvidia scales. That is healthy for innovation, but it puts pressure on operating leverage if revenue ever cools. And finally, valuation risk. Nvidia trades at a premium multiple because investors expect hypergrowth to continue. If the pace deaccelerates further, the stock can reprice hard even if the business is still elite. Great companies can be bad investments if you pay too much for them. The takeaway: Nvidia has a wide moat, but it is not invincible. Customer concentration, policy risk, rising costs, and lofty valuation are the forces you must respect. This is high reward, but it comes with high volatility. So is Nvidia a good long-term investment? The core question is simple. Can anyone realistically displace Nvidia over an investment horizon that matters? Start with the moat. CUDA is not just an API. It is a living ecosystem of compilers, libraries, kernels, and workflows that developers use every day. Models, code bases, and playbooks are built on it. That creates switching costs that feel like wet concrete. The longer it sets, the harder it is to rip out. Now layer the system. This is not a chip sale. It is a solution. Blackwell GPUs, NVLink, InfiniBand, Spectrum, Ethernet, and the software stack ship as an integrated platform. That platform turns data centers into AI factories. If Nvidia sold parts, a rival could slot in a comparable part. But when customers buy the whole stack, replacement is not a part swap. It's a multi-year migration with real risk and real cost. Could competitors win workloads? Yes. Hyperscalers will use in-house silicon for specific tasks, and a rival can score wins where performance per dollar is superior. But the burden of proof sits with the challenger. They must match the hardware, the software, the tools, the developer mindshare, and the support model. That is a tall order at global scale. The bull case: a wide moat driven by CUDA and full stack integration, expanding demand across cloud, enterprise, and sovereign AI, and a platform that becomes the default choice. The bear case: customer concentration, policy shocks, and credible in-house or rival silicon carving out pockets of demand and pressuring pricing. The bottom line: Nvidia remains a strong long-term investment if you size it with discipline. CUDA and the system-level stack make displacement slow and very expensive. The moat is wide, but not absolute. Own it for years, expect volatility, and let the platform advantage do the heavy lifting. So what am I doing right now? Here's my decision. I am holding. Nvidia is my second largest position, and that does not change. I may look to add on real weakness when price disconnects from fundamentals. Here is the real checklist. Is the business getting stronger every quarter? Yes. The company guided to about $54 billion next quarter, which implies roughly 15% growth quarter over quarter if they deliver. Are the numbers trending up across customers, contracts, revenue, and cash flow? Again, yes, with cash flow noise coming from taxes this quarter. Is the product becoming harder to compete with? Absolutely. The full system of Blackwell, NVLink, networking, and CUDA makes switching slow and expensive. Why the stock pulled back matters for execution. Expectations ran hotter than the print, and the mix shifted toward networking. That spooked investors who wanted another surge in compute. That is a stock reaction, not a business failure. Operationally, this quarter reduced risk because demand, margins, and guidance were strong. Market-wise, this quarter increased risk because expectations need to reset. Said simply, business risk is down, stock risk is up. Position sizing is the edge most investors ignore. This is a high-reward company with high uncertainty. It can compound for years, and it can still draw down fast when narratives turn. For most portfolios, Nvidia belongs as a meaningful but controlled slice. It's not an all-in bet. If you cannot hold through volatility, size smaller or stay out. The bottom line: I am holding my overweight position, and I may add on big pullbacks. The thesis is bullish and the risks are real. Customer concentration, policy headlines, rising expenses, and a premium valuation can hit the stock at any time. You win here by knowing exactly what you own, why you own it, and how much you can carry without flinching. So let me ask you something. Who else is showing you why Nvidia's stock actually pulled back, breaking down the real risks, the CUDA moat, and the trillion-dollar AI build-out, while also showing you exactly how to build a position with conviction? Who else gives you both the bull and the bear case, shows you the thesis, and then puts their own money on the line? Nobody. That's why Nvidia is my second largest holding. I've got 7 figures on this stock, and I'm still holding. And it's not just me. We are crushing it in so many ways. Wreaks Havoc just pulled in another $3,117 on a single ETF trade. And my own accounts are up 54.64% year to date with over $1.9 million in gains. This is not theory, this is execution. Inside my Patreon, you get real-time trade alerts with entries, exits, and the full why behind every move. Daily market breakdowns, no fluff, just what matters, and the exact strategy I use to scale a seven-figure portfolio with discipline. It's only $30 a month, and people blow that on Uber Eats without even thinking. This could actually pay you back. If you've been watching my channel and telling yourself I should join, then it's time. Stop watching, start building, because you can scroll or you can scale, but either way, don't say you weren't told.